Hi everyone, thank you for joining me today. My name is Kathleen Oviedo and I'll be your host for today's webinar titled The Little Known Rules of Social Security You Need to Know. Joining me today is Rob Bray, Relationship Manager for AAFMAA Wealth Management Trust. If you have a question during the presentation, please feel free to reach out to us by phone or email. This monthly webinar series is brought to you by AAFMAA Wealth Management Trust. Our vision is to ensure the financial security and independence of members of the Armed Forces community, active, retired, honorably discharged service members, and their families. We accomplish this by being the premier provider of financial planning, investment management, and trust services for all branches of the military. We are AAFMAA's trust company. AAFMAA stands for American Armed Forces Mutual Aid Association. AAFMAA, created in 1879, is the longest-standing, not-for-profit association exclusively serving the military. We empower military families with affordable financial solutions. AAFMAA focuses exclusively on the needs of military families and provides innovative, personalized, and lifestyle-appropriate financial services. A key point that sets AAFMAA Wealth Management Trust apart from other companies is that we are fiduciary. What that means is we have a legal obligation to act in your best interest and for your benefit. One important disclaimer before we begin this month's webinar. The information presented herein was compiled from sources believed to be reliable. This presentation is for educational purposes and is furnished without responsibility for completeness or accuracy. External information is not specific investment, legal, or tax advice for any individual. Do not rely on this presentation alone to guide your financial planning decisions. Since each individual situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. We've produced this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources that are available to them. I will now turn it over to Rob to begin the presentation.
Thanks, Kathleen. Here's our agenda for today. Please note that there's a lot of topics here, and I understand that. So the way this webinar is set up, we're not able to take questions during the webinar, but at the end of it, you'll have contact information of who you can address your questions to, and we'll get back to you with every question that you have. As Kathleen said, many details for the various scenarios can vary, and it's important that you don't take any action on this set of information per se without contacting your tax professional and or the Social Security office to make sure you fully understand the ramifications of any actions. Just as a brief overview of Social Security, in July of 2018, 62 million people received a Social Security benefit. 62% of those beneficiaries are relying on a monthly check to at least half their income. 34% rely on a payout for 90% plus of their income. The difference in the amount of a Social Security draw varies up to 76% more between the ages of 62 and 70. So with such a large population being reliant on this entitlement, it's important to fully understand the many different aspects of the draw amount that can be drawn at any specific time. These facts are provided by the Social Security website. So let's look at Social Security eligibility. Most people know that you're eligible at age 62. But here's something that I've been surprised. Some people feel that at age 62, you have to begin drawing Social Security. That's not true. You don't have to begin at that age. You can defer it to as late as age 70 with as much as an increase of 76% in the amount that you draw. Something else that some are unfamiliar with is that widows may begin their draw as early as age 60, but at a significant decrease. And there's even an entitlement for up to age 50 if they're disabled. Children of recipients under the age of 19 or still enrolled in high school are eligible for up to 50% of the recipient's draw. Now, this also includes grandchildren, which oftentimes folks aren't aware of, as long as one of the grandparents is drawing or if one of the parents is deceased. The other parent or grandparent is also eligible for partial draw until the child turns 16, and that's regardless of that parent's age. Now, there is an overall max household draw limit. So let's look at eligibility for divorced spouses. This is an area that is often not understood. Divorced spouses are eligible for a draw on their ex-spouse's earnings beginning at age 62, provided they were married for at least 10 years and did not remarry. Now, the IRS is very picky about this. it cannot be 9 years and 11 months. They count down to the exact date. So you've got to be at least 10 years married for this to count. Now, this is assuming that the ex-spouse is entitled to Social Security and is age 62 years or older. Now, this does not impact the ex-spouse's draw in any way, nor does it impact the ex-spouse's new spouse or dependents in what they have, and they do not have to be contacted to initiate this draw. If the ex-spouse has not applied for retirement benefits but can qualify for them, you can still receive benefits on their record if you've been divorced for at least 2 years. Let's look at draws and how it's based on your income. To be eligible for Social Security, you have to have 40 quarters of paying into the system or 10 years. Now, one quarter for 2018 was $1,320, so 4 quarters is $5,280. But here's an interesting note. This money does not have to be spread out throughout the calendar year. So as soon as you earn $5,280, you have earned 1 year or 4 quarters of credits for Social Security. If you have a good enough job, you could potentially earn that in 1 month. But regardless of how much money you make, $1 million, the most quarters you can earn in 1 year is 4. Now, your draw is going to be calculated using the highest earnings over a 35-year period. Now, I realize I just was talking about 10 years, and now I'm talking about 35 years. Well, you may increase the Social Security draw if you return to the workforce later, because what Social Security does is when they calculate your highest earnings over a 35-year period, any years that you did not contribute to Social Security, they add a 0. And that withdrawal, when that 0 is there, when they add up your overall calculation and figure out how much you're going to draw, that has a drawdown impact on the amount of money you'll get. So when you return to the workforce, any amount of money that you earn, any amount above 0 could potentially help increase your draw. And this is also regardless of your age. You can be 90 and go back to the workforce and still potentially impact the draw of how much you're going to get. Now, you will not be penalized if you have some low earnings once you return to the workforce, as long as you're not at full retirement, as long as you're doing it before full retirement age. Now, if you do it at full retirement age or afterwards, there's no penalty. If you have earnings and you go back to the workforce, and I'll talk about this in a minute, you could have some potential impacts there. But the bottom line is that by going back to the workforce, if you make a lower amount than what your high 35 was, you will not be penalized for that. The maximum wage base for Social Security taxation in 2018 is $128,400. Now, this amount is indexed for inflation and it increases annually. Earnings above this amount will not be taxed for Social Security in that same year. However, they may be taxed for Medicare, which is 0.9%. But be mindful of this, that if you make that much money or more at one job in a year, and then you transition to another job in the same year, the Social Security clock, so to speak, is going to start again, and that employer will begin taking out Social Security on you. Now, you'll get that back when you file your income taxes at the end of the year. Speaking of taxes, let's look at how Social Security is taxed very briefly. Up to 85% of a Social Security draw may be taxed at the federal level. It also can be taxed at the state level. But 15% will always be tax-free, always. Now, if Social Security makes up the vast majority of your retired income, your benefits may not be taxable at all. If your combined income is over $44,000, you're married filing jointly, or $34,000, all other filing statuses, as much as 85% of your Social Security benefits may be taxable income. If your combined income is over $32,000, married filing joint, or $25,000, all other filing statuses, as much as 50% of your Social Security benefits can be taxable. So the tax brackets there, 85% if you're married filing joint, $32,000 to $44,000. The 50% bracket, 25% to $25,000 to $34,000, single or all other statuses. And the sad thing is these dollar amounts are not indexed for inflation. So over a more period of time, the odds of you having to pay taxes on your Social Security will increase. Very briefly, the 4 states that mirror the federal tax schedule for Social Security are Minnesota, North Dakota, Vermont, and West Virginia. The 9 states that tax Social Security at varying levels are Montana, Colorado, New Mexico, Utah, Nebraska, Kansas, Missouri, Connecticut, and Rhode Island. While your Social Security may not initially be taxed, you have to be mindful that you're going to have to initiate required minimum distributions, or RMDs, from your thrift savings plan, 401k, 403b, or traditional IRA, beginning at age 70 and a half. This income, when added to your Social Security draw, may cause an increase in taxes, and I recommend you consult with your tax professional prior to that action. Okay, so let's talk a little bit about beginning your draw. When you begin your draw, the Social Security representative will normally offer you the option of receiving 6 months back pay, assuming you're at least 62. Now, you may think, holy boy, this is a great deal. Be very leery of this. If you accept this offer, you are essentially taking a discounted Social Security draw of up to 4% annually for the rest of your life. So if you're going to be receiving Social Security for potentially 25, 30, or more years, discounting that draw, that total draw over 4% is a tremendous amount of money, significantly much more money than you would get for that 6 months that you'd pay up front. What Social Security does, in essence, is they backdate the start date of your Social Security. So remember that your draw increases up to 8% per year that you delay your draw. So if you cut it in half, you start at 6 months earlier, that's 4% less that you'll get, and that's for the entire lifetime that you draw Social Security. If you begin your draw prior to full retirement age, you may incur a penalty for your earned income. And some folks aren't aware of this. So from age 62 to full retirement age, you have a penalty of $1 withheld from Social Security for every $2 you earn over $17,040. In the year you reach full retirement age, this amount increases to $45,360, and the penalty is $1 for every $3 earned over this amount. Now, these amounts are indexed for inflation. Now, something some folks don't realize is this money is not permanently lost. When you reach full retirement age, Social Security will recalculate upwards the amount of your benefits to take into account the amount you lost because of the earned income rule. The lost amount will be made up only partially, however, over a little bit each year, and it'll take up to 15 years to completely recoup the lost benefits. But note this. If a member passes before the 15-year period is up, there's no lump sum available for the survivors. That's simply lost income. If you're still working and want to begin your Social Security draw, discuss the possible consequences with your tax professional beforehand. And for survivor benefits, this is key. There's no increase in the draw beyond full retirement age. Widows are entitled to 100% of their deceased spouse's entitlement at full retirement age. Now, continuing with the draw, the bottom line is that when you begin Social Security is really a personal matter of decision. The most overriding factor could be if the worker's financial situation is such that the extra income from Social Security is required for their financial survivor. The age at which a worker begins draw Social Security may have a significant impact on their overall lifetime draw, because as soon as you start drawing Social Security at whatever age, before age 70, that is going to be the entitlement that you're going to get throughout. Now, it's indexed for inflation, obviously, but you won't get any extra income because of any sort of a delay because you've already started it. The tips provided in this brief, as we said up front, are for information only. Workers are encouraged to discuss any planned action with their tax professional and or a Social Security representative before taking any action. Now, on chart 14, we have the various ages associated with full retirement age. It starts at 65 for those who were born in 1937 or earlier, and up until age 67 for those who were born in 1960 and later. So full retirement age means the age at which the recipient can receive 100% of their Social Security. However, remember that if you delay up until age 70, the amount of the draw can increase up to 8% per year for the draw all the way up until age 70. There's no extra increase after age 70. Now, some additional reductions in Social Security draw, and these are two programs that a lot of folks get caught short on because it is really unique. If the husband or wife did not pay into Social Security while working, then their draw may be significantly reduced permanently. Now, this often occurs when a worker, he or his spouse, are employed by a state or municipality, and Social Security is not withheld. Oftentimes, they pay into their own retirement system. And I know in the federal government, there used to be a program called Scissors, and that program went away in 1983. But the folks who were paying into that system did not concurrently pay into Social Security. Now, there's two programs that impact this draw. The first one is the Government Pension Offset, or GPO. This normally impacts the spouse's draw. Let's say, for example, the wife, when the spouse did not pay into Social Security, meaning the husband. The spouse's draw may be reduced up to 2/3 because the spouse did not pay in. Now, the windfall elimination provision, this is a reduction in Social Security benefits when the worker, say the wife, does not have 30 years or more substantial earnings tax for Social Security. Both the spouse draw are significantly impacted. However, the survivor draw is not impacted. So, if the wife did not pay into Social Security, or she paid in just very little, and when she starts to draw, her spouse's draw is going to be significantly reduced. However, because her draw is going to be reduced for Social Security if she qualifies. However, when she passes, the surviving spouse will get a draw as if this program was not in effect. Now, a do-over is allowed. Now, what do we mean by do-over? If you begin your draw and decide that it was a mistake, you realize about the penalties that you have to pay for $1 for every $2 or $1 for every $3, you can cancel your draw within the first year and return all the payments you received. There's no interest that's required for that. Now, you're only allowed to do this once in your lifetime. Now, something else you can do that some may not realize is you can also suspend your draw beginning at full retirement age up until age 70 and resume it at any time. Now, why would you want to do this? Because remember, each year that you delay, your draw can increase up to 8% annually. So if you're delayed beginning at age 66 to continue to age 70 or 4 years, your draw may increase up to 32%. That's a significant increase in the amount that you receive. Note, though, however, if you have children or dependents that are receiving a draw based on your entitlement, their draw will also be suspended during this period, except for divorced spouses. Now, preparing for Social Security, one thing I think that's very important to consider doing is going online and opening an online account. Here's the website that you can do that. And if you have questions, you can contact the Social Security for this issue or anything else at this number here. Just be aware that you're going to have to wait a while to get an answer because they are very, very busy. But again, this will allow you to get an online access to your earnings records, and it will also have an estimate of what your draw will be at various ages. Now, what happens if you're not satisfied with what you're told about your Social Security decision? Remember, over 10,000 workers are becoming eligible for Social Security daily. That's a lot of influx. Many Social Security offices are understaffed, and new employees may be adequately experienced and trained. You may receive incorrect information from Social Security. If you question their answers, don't hesitate to ask to speak with a supervisor at Social Security. I know that when I've represented clients on 2 particular occasions, Social Security was adamantly wrong in what they said. One time, they made a correction because it did impact the members' benefits right then. The other time, I chose not to argue because I knew I was right, and it wouldn't impact that member's benefits until they passed, and I would address it at that time. Okay, here's a book that I've read twice, and I would recommend it to anybody who really wants to get some more details. It's very user-friendly, lots of good facts. It's been updated with the latest Social Security changes and has some very good information on how you can prepare to make a decision on when best to draw Social Security. I hope this brief has been of information to you, and I look forward to hearing any questions that you have later on.
Thank you so much, Rob. That was incredibly informative. If you submitted a question during the webinar, please be on the lookout for a response from one of our AAFMAA Wealth Management and Trust relationship managers in the following days. If you think of another question later, please reach out to us at wealthmanagement@afma.com or to Rob directly at rray@afma.com. We'll go ahead and break here for now, but please don't hesitate to reach out to us for assistance whenever you need it. We do this every day for our military community, and it is our pleasure. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. And you can always register for future webinars and review past webinars at afma.com/webinars. Speaking of future webinars, be sure to join us in 2 weeks when our team at AAFMAA Life Insurance presents. If you found this information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduce those in your military community to AAFMAA. Thank you again to everyone listening for joining us today. We look forward to our next opportunity to assist you.